Let's bring in former Moody's chief economist John Lansky, former CBO director Douglas Holtz-Eakin. Gentlemen, thank you for joining us. You know, John, all of this denialism and happy talk out of D.C. is panicking people more. John, regional banks, they're like now in a negative feedback loop. We've got a growing credit crunch now underway. What other shoes do you see dropping?
Well, you know, you're going to see a reduction in the supply of credit to businesses, perhaps the consumers. You'll see a continuation of very wide spreads between mortgage loans and the underlying Treasury securities. All of this points towards slower economic activity, and eventually some of these borrowers are going to run into more problems repaying outstanding loans. Right now, the big worry is commercial real estate loans as they relate to offices and retail space. I wouldn't be surprised if a year from now we become very concerned about real estate loans that finance the construction of multifamily housing.
All right, so what John just said, you know, Douglas, we see striking denialism, Douglas Holtz-Eakin, out of the White House, out of Democrats in Congress, out of the Fed. It sounds like they're not up to speed on what's going on. I know that they're watching it. We know that they're watching the data. But Jamie Dimon cannot rescue everyone. The problem is it now takes a split second to move your money out of a low-yielding 1% bank account to a higher-yielding 5% money market fund. We said that 2 months ago. The Fed keeps raising interest rates. That's rocking the banks.
Well, certainly I think the Fed is stuck in a bad place because inflation is still stubbornly high. Year over year, inflation on food, energy, and shelter is still 6.4%. Americans are very unhappy about that. And so the Fed's got to respect the data and get inflation under control. That's their first mission. They thought they could do that and keep the bank stability issue under control. Doesn't look like it. So they need to do something they didn't do with Silicon Valley and some of the other banks, and that's get the supervision out there right now, sharp pencils, identify the danger points, and start arranging for some marriages so that we don't have the American public panicking over the entire banking system
but that makes
when the problem really is focused on those regional banks.
But Douglas, that makes the banks even bigger, and that's what Democrats have been complaining about. You know, we're seeing like numbers coming in, $650 billion in unrealized losses on just securities alone. Penn Wharton, NYU, says it's more than double that. Now they want to backstop all the deposits, get rid of the insurance limit for uninsured accounts. At the same time, they want to subsidize riskier borrowers, mortgage loans paid for by good credit borrowers, John. This is insanity.
Yeah, you're right. And, you know, I guess one of the big problems is, you know, where does all this stop? We've reached a position that if the Federal Reserve or the government fails to bail out depositors in the event of widespread failure, bank failures, we'll have a huge political problem on our hands. That would be for the Democratic Party, making it next to impossible for the Democrats to win it, the 2024 presidential race, I would think. So as far as the safety of money in the bank is concerned, I would still look at it as being money in the bank, that it's still relatively safe, that it would be political suicide for any party in power to allow deposits not to be fully repaid, especially after the bailout of wealthy depositors at Silicon Valley Bank.
Yeah, and the final word, Douglas Holtz-Eakin, how does this hit the 2024 race?
This hits the 2024 race by raising the probability of a recession. It was already way too high. And so now you've got a president who's going to run on his record handling the economy, who's got stubbornly high inflation and a recession staring him in the face.
And now a bank crisis. And now a bank crisis. All right. Gentlemen, great insights. That was terrific. Thanks for joining us tonight. We appreciate you.